All right, today we are going deep inside Nike's latest quarterly report to really get the story behind the numbers. And it's a fascinating one, let me tell you. It's all about a massive strategic trade-off where profits have absolutely tanked even while sales are kind of holding steady. So let's get right into it.
Okay, right out of the gate, you see this weird contradiction. Nike's revenues, the total cash coming in the door, are up just 1%, basically flat. But then you look at their net income, the actual profit they get to keep, and it's fallen off a cliff, down a whopping 31%. So the big question is, if sales are stable, where in the world did all the profit go? That's the mystery we're going to solve.
To figure this out, we have to look a little closer at the numbers. And that brings us to what I'm calling the margin mystery. Because the key, the real clue to unpacking that huge 31% profit drop, it all comes down to one single super important number.
And that number is gross margin. Now, don't let the term scare you, it's actually pretty simple. Think of it like this. For every $100 pair of sneakers Nike sells, the gross margin is what's left over right after they pay for the leather, the rubber, the factory labor, all the stuff that goes into making that one shoe. It's the pure profit on the product itself. And you can see why it's so important, right? If that number starts to shrink, the entire company's financial health starts to get shaky.
And shaky is putting it mildly. Nike's gross margin dropped by 320 basis points. Now, basis points is just Wall Street talk for 0.01%. So 320 basis points is a 3.2 percentage point drop. For a company the size of Nike, that is a huge deal. It means on every single thing they sell, they're making significantly less raw profit than they were just a year ago.
So what's causing the squeeze? Well, Nike lays it all out for us in their report. And what's really interesting is how this corporate speak connects to stuff you've probably seen yourself. You see higher discounts and increased markdowns. That's that giant sale you saw at the outlet mall. You see increase in product costs? Well, that's the invisible force making everything more expensive to produce. It's like a perfect storm of having to sell old stuff cheap while the cost of making new stuff keeps going up.
But, this is Nike we're talking about. They're not just going to sit there and watch their profits evaporate. They have a plan. So let's check out how they're planning to fight back and reignite that classic Nike momentum.
Their strategy is a really clear two-part pivot. First, on the product side of things, they're actually making less of certain shoes on purpose. The idea is to create a little scarcity, clear out the clutter, and make room for brand new, innovative stuff they want everyone talking about. Second, and this is a major shift, is how they sell. They're trying to stop the constant online sales and make their own website a full-price destination again. At the same time, they're actually reinvesting in their partners, the Foot Lockers of the world, to help them sell through the old inventory and make the brand look great in physical stores.
And make no mistake, this isn't some panic move. It's a very deliberate choice. You can see it right here in this quote from their own management team. They want to reignite brand momentum and reposition our business to drive long-term shareholder value. In plain English, they're basically saying, look, we know our profits are taking a beating right now, but we believe this is what we have to do for the health of the brand for years to come.
Now, it's so important to remember that Nike is this global beast, and the story isn't the same everywhere you look. In fact, those big global numbers we've been looking at, they're actually hiding two completely different stories playing out in their biggest markets.
Now you can really see the split right here. Look at that. On their home turf in North America, sales are actually growing by a pretty healthy 4%. But then you look over at Greater China, which has been this massive growth engine for them, and revenues are down a pretty scary 9%. It just shows you the problem isn't everywhere. It's really concentrated in some super critical places.
And if you think that's a big difference, the profit story is even more dramatic. Yeah, profits were down 7% in North America, which isn't great, but they absolutely cratered in Greater China, dropping by 25%. This tells us that margin pressure we talked about earlier, it's hitting some parts of the world way, way harder than others, and it's dragging the whole company's average down.
Okay, so we've unpacked the problem, we've looked at the strategy, and we've seen how different things are around the world. So let's bring it all together and talk about the road ahead. What are the big things we should really take away from all this?
So here's the story in a nutshell. Revenues are flat, but profits fell off a cliff. The main villain? A shrinking gross margin, getting squeezed by discounts and higher costs. Nike's response? They're hitting the reset button, clearing out old inventory, totally changing up their sales strategy, and trying to focus on fresh products. And this whole drama is playing out on two different stages. North America, which is holding up, and Greater China, which is facing some serious headwinds.
So if there is one single thing to take away from all this, it's this. What we're seeing in Nike's numbers is not just a bad quarter. It is the financial result of a massive strategic bet. They are consciously and very deliberately trading away profits right now for what they hope will be a much stronger brand and a better position in the market for the long haul.
And that, of course, leaves us with the big, multi-billion-dollar question. Nike's whole ethos is just do it. Well, they are definitely doing something big here. But is this strategic pivot going to be enough to win the long race? Honestly, only time will tell.